Hi, everyone, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your host, Denny Troncoso. And I hope you're all staying home and healthy. We're definitely in a new normal with this COVID-19, aka coronavirus. It caught some major investors by surprise, including ourselves. And we actually been selling some properties, and man, it caught us completely blindsided. A property was getting ready to close in 5 days. The lender really tried changing the terms on the borrower, where they ended up not working. And luckily, the borrower has another lender they're working with, and that's going to allow us to close the deal next month. Now, this is episode 17, and if you were with us on our last podcast, episode 16, I gave you a breakdown on the documentary, The Retirement Gamble, and it explained on ways that people are gambling their retirement dollars away. So check it out. Now, in this episode, we have James Eng to talk to us about lending programs for real estate and also some of the government support programs in the CARES Act. But this is changing daily, so we're going to release some of the information that we have available now. James is a senior director for Old Capital, and Mr. Eng is actively involved in financing commercial real estate with a focus on multifamily in the state of Texas. He's financed over $800 million in multifamily properties, over 125 properties since 2015. So he's been pretty busy. And before joining Old Capital, Mr. Eng underwrote over $750 million in loans over 8 years for the acquisition or refinance of commercial properties with GE Real Estate. Before he was with GE, he also was part of GE's financial management program at GE Capital, working in Connecticut, Colorado, and Texas over different businesses with the company. He has an undergraduate finance degree from McCombs Business at the University of Texas at Austin. And this show is going to be available on YouTube and anywhere you could find your podcast. So be ready to take notes. If you don't already, make sure to follow us on Instagram at Denny Troncoso and at Desi Troncoso. And with that, James, are you there?
I'm here. Let's get it going.
All right. Thanks for being on the call. I appreciate it. It's especially short notice.
No problem. Yeah, thanks for having me. I mean, there's a lot of movement in the market, so happy to take any questions and give people a little insight into what we're seeing on the financing and acquisition side on the multifamily side here in Texas.
Excellent. Well, before we kind of jump into that, tell us a little bit about you. I know you have a finance degree and you've worked with GE. Can you tell us a little bit of that transition period? Why a finance degree? And then a little bit about your time at GE before getting into commercial lending.
Yeah, I mean, I grew up in Houston, went to school in Austin at UT, and actually started as sort of engineering pre-med. Huh. And then my dad said, "Oh, you're really good in math and science, so you should do engineering pre-med." So that's what I did. I dropped engineering after one semester, moved over to business. And then after 2 years, I dropped medicine and moved into full-time business. So it was more of a process of elimination. I did everything that Asian kids are supposed to do: engineering, pre-med, and business. So I ended up in business. I came out of school with finance degree and went to work at GE. And there I was in more of a rotational program. And one of my rotations just happened to be in real estate. So I was essentially like a mini CFO for all these different businesses. And my job at the real estate group was to just run the P&L of the business. But then eventually I was like, I really like this real estate business. I really like seeing what we do to make money, which was loan people money and hopefully get it back. And so as part of that program, I got to be sort of like a assistant underwriter for 6 months. And then I ended up just joining that risk team and ended up staying there for 8 years. And they really never hired anyone into that group except people with like 15 or 20 years experience. So I was like the youngest guy by far. Awesome. And I just followed around underwriters essentially for 7-8 years, underwriting office, industrial, retail, multifamily, self-storage, everything that you could think of, we gave a loan on. And I got to see sort of through the last recession, 08, 9, 10, we gave bridge loans and CMBS loans. CMBS loans ended up pretty much being fine because they were stabilized deals and we had 10-year loan terms. But the bridge loans, the 3 to 5 year loans, that's where people got in trouble, and that's where we sort of had to work those out. And what I saw was multifamily and self-storage were the two asset types that we didn't have to take back. So we took back office, industrial, retail. We took back all those properties through foreclosure on our bridge loan program in the last recession. That's probably what's going to happen on this recession as well. So I said, all right, so in 2015, I started looking at investing sort of from my own account. And I was like, all right, what asset type should I start with? And I looked very heavily at multifamily and self-storage. And multifamily, I just found more opportunities as people were syndicating deals, so I could invest as a limited partner. And I started investing as a limited partner in 2015. And I've done about 25, 26 properties since then. So I try to do about one a quarter in terms of investing passively. And so now I get cash flow from all those properties to some extent. They've sort of put some of those distributions on hold, but essentially the last 5 years, that comes in either monthly or quarterly. So I sort of switched. I haven't listened to all your podcasts, but my previous strategy on retirement was sort of like put it in a 401k, put it in a Roth IRA. And then I realized in 2015 that none of that stuff cash flowed. So I moved it all over to multifamily, and every month, every quarter, that's where I get my cash flow. Even though right now the distributions are limited, once we sort of get through this COVID-19, the distributions will turn back on. So that's it in a nutshell.
All right. And then, some of the points you mentioned, a really great point there. Office, retail, industrial, all those property types, all those asset types had problems during the downturn of 2008 to 2010. So self-storage and multifamily were the ones that kind of worked through the process, and you guys didn't have to take back. So that's a good no for people out there looking to invest on some of the assets that are a little bit safer. I'm not saying that you can't invest in office and retail, but you do need to have a stronger balance sheet to hold through some of these down times. Am I right, James?
That's absolutely right. What we saw was, in, let's say, 06 or 07, we would see an office building, it'd be 100% occupied, or a retail strip center 100% occupied. But at 60% occupancy, it can't pay the debt service, right? And then multifamily, it dipped, right? So it made it, you went from 95 down to 90, even 85 to 80. But the good operators sort of adjusted their rents, kept their occupancy high, and they could still service the debt. So even if the bridge loan hit a maturity, we typically would just give them a year, 2 years, and then let them sort of ride it out so that they could either sell or refinance at that point. So, but the office, those guys, just office, retail, industrial, if they drop to 30, 40% occupancy, they did not have enough money to cover those payments.
Yeah. And that's a story about right now. So that those are just fantastic points. So you mentioned your history with GE. I think that working in underwriting really put you in a good position to then do what you do now, which is underwrite loans with old capital. Am I right? That helped with that transition?
Yeah, it made it really easy. If you ever try to learn how to underwrite office, industrial, retail, and compare that to multifamily or self-storage, multifamily and self-storage are actually pretty easy. And so, you don't have to forecast, rollover schedules and TIs and all these other things that you have to forecast. Multifamily is pretty straightforward. So that's allowed me to come to become essentially like a mortgage broker. That's what Old Capital is. And what I do is help people sort of figure out what their strategy is for their acquisitions, right? So whether that's Fannie Mae, Freddie Mac, a bridge loan, recourse bank loan, we sort of look at your experience, but then also where the property is in terms of occupancy, in terms of how much CapEx it needs, and figure out what the best financing for that property is based on your strategy and what you're looking to do with it.
Great. So that Old Capital is a mortgage broker. And then what a mortgage broker does, and you can correct me, James, I come to you if I need lending for a property that I'm purchasing or that I own and I'm going to be refinancing. And you go out to the market, you typically have a number of lenders, hopefully 50s or hundreds of lenders that have different appetites for different types of loans. And you can kind of match me up with the person the bank that's looking to work with people like me. Am I right?
Yeah, that's right. In today's market, what people are running into is if they had a relationship with just maybe a local bank and that local bank stops lending, then they need somebody else to come in and show them, all right, maybe a bridge lender can come in, maybe Fannie or Freddie, and just understanding all those terms and their lending appetites at the time, right?
Mm-hmm.
So a lot of those things are moving around, especially like the guy who's buying your property. They were thinking Fannie Mae or Freddie Mac the whole way until Fannie Mae and Freddie Mac just instituted essentially like a 12-month interest reserve or even 18-month interest reserve on loans under $6 million. So that can put a big hiccup, especially if that's your only relationship. Like if your only relationship is I'm going to have a Fannie Mae guy and that's it, then you're in trouble, right?
Mm-hmm.
Because if Fannie and Freddie stop lending, you're going to have to sort of reshuffle the deck and recapitalize it another way. And so that's what our expertise is that we have a lot of lenders in a lot of different scenarios. And so people call us when on the front end of a deal to make sure we size it, make sure there's no issues with Fannie or Freddie or CMBS or any of these different lending types. And so we look at 4 or 5 different lending options, present that to the borrower, and then sort of give our recommendation on which way to move forward.
Got it. Okay. Can you go over some of those lending types that you work with? Maybe, I know you probably have so many, but maybe some of the top 3 to 5, maybe like your Fannie Freddie, your bridge, and then one of the community banks, what they were pre-crisis, and then what are the terms that you're also seeing now where we're at in this new normal?
Okay. So let's just start sort of, let's say 2018, 2019, what people were doing in the last year. I mean, Fannie and Freddie, they were both 80% levered. Okay. They could do a 10-year loan, non-recourse with 3 to 5 years interest only and 30-year amortization. Okay. So that is pretty much what most multifamily owners did if they had a stabilized property and were looking to hold the deal long term. If you wanted a heavier rehab property, shorter term, most people are doing bridge loans. So that was 3 to 5 years. It could be 80% loan to cost, and it was typically on a floating rate. And so that rate was probably around 5 to 5.25 on a floating rate. But you would only have a 3-year term, maybe with 2 1-year extensions. And Fannie and Freddie, most people were doing those for 7, 10, or 12 years. And then the last one, recourse bank loans, that's really max leverage was really 75%. It was recourse to you personally, but you did not have a big prepayment penalty. It was typically like a 1% prepayment penalty. And they were typically maxed out at about 25-year amortization, typically 1-year interest only on those. So if it was your first deal and it was a smaller deal, some people usually started at the recourse bank loan, then graduated to Fannie and Freddie. And then as you had more and more experience and you wanted to take on more challenging properties, you would move into the non-recourse bridge. So that's where I see sort of people stair-stepping it up is they start sort of recourse bank loan, 1 to 3 million, maybe 1 to 4 million. They do Fannie and Freddie on stabilized properties, and then they move to bridge non-recourse if they want something a little bit, take on a property that's a little bit more challenging.
Okay.
Is what I've seen. So the big change now in the last month or so is Fannie and Freddie instituting interest reserves. So they're putting up anywhere from 12 to 18 months interest reserve. That's P&I plus real estate taxes plus insurance plus replacement reserve at close. So just to give you an example, we had a $7 million loan here in Dallas, and the reserve was close to $500,000. So somebody was essentially raising $3 million for the equity raise. It was about $10 million property. And they had to put up an additional $500,000 at close for this interest reserve for the lender. So that's essentially, effective immediately on a lot of these loans. So until coronavirus sort of comes through and everyone goes back to work and then they see collections stabilize, Fannie and Freddie are going to keep that in place.
Got it. So 12 to 18 months interest reserve plus regular replacements reserve, and there were other things, so taxes, insurance, all in there for
12 months.
Wow. Okay.
Yeah, so you're putting it all up front.
So you're saying that in these particular deals, that if a syndicator's putting it together, they're raising, like you said, they're raising a good amount of money. Now they also have to raise that extra $500,000. So returns overall are being impacted with that.
Absolutely.
So maybe less deals get syndicated just because of that, unless sellers are willing to reduce the price to account for that.
That's what it is. So it's yeah, right now there's a gap in the market, right, between sellers and buyers. And so what we're seeing is a lot. I mean, I probably had 4 or 5 deals that were sort of best and final going into March. And then, from the original offer to the best and final offer, some of them dropped by 10% in their price just because of this interest reserve, because of the volatility. So we've seen interest rates spreads. So there's two things that make up your interest rate. One is the 10-year treasury, and then the spread that Fannie and Freddie charge. And so Fannie and Freddie essentially blew out spreads a lot, even though interest rate 10-year treasury is down at, like right now, it's 0.6%, which is almost nothing. They put a floor on the treasuries and then also added a bigger spread. So we're seeing, probably 3.75 to 4 on Fannie Mae, and then Freddie Mac's probably 4.5 to 5 right now on interest rates. But because of that volatility, people are hesitant to go hard with a lot of money. So in Dallas, most deals were 3, 4, 500,000 hard day one, and now it's cut back to maybe 50,000 on any deals.
Well, I'm taking notes here. This is interesting because what you just said is exactly what happened to our borrower. So first, it was a little weird, and I'll ask you about this. But before we get into it, they did do the interest rates just shot up. So we were trying to find a way to work through it, some of the requirements, but then he compared with his local community bank, which the rates were still at 4%. And then Fannie was at 5% or 5 plus. He said it isn't even worth it anymore if we can find a solution, because the rate that I'm going to be locked into, it's not going to work for me.
Right.
So this is just explaining that 100% there. Now, and can borrowers do anything? And I know this is pre-crash, pre-coronavirus. Can they do anything when they sign that term sheet? Because what happened to the borrower in my case was 5 days before closing, they just changed everything up. And they said that in committee, they decided to change it. And this was what are your thoughts on that?
So Fannie used to have what was called a streamlined rate lock. And essentially you could rate lock probably about 15 to 30 days after you signed the loan application. So once engineering, environmental appraisal came back, they underwrote the borrower. They said, all right, you're good to go. The borrower would put up 2% of the loan amount. They would lock the rate. Okay. And then you could close, 30 to 45 days later, but they took it away. So Fannie Mae said, we're not going to do early rate lock anymore. And now you essentially, like, if you wanted to close next week, you could rate lock this week and close it next week, but that's it. So you have to be essentially 5 days out from closing.
Got it. And that was like the same deadline with it. So they removed this streamlined rate lock, and then that kind of took that off the market. So your only option as a borrower, when you put up that money, it's completely at risk, and then extra money, because they even charge the borrower like a $2,500 processing fee, $5,000 for attorney's fees. Is that money completely gone? Can you advise on that as a borrower, or even people that are listening?
Yeah, I mean, Fannie and Freddie, I would say Freddie SBL is a little bit lower. So it's about $10,000 to get the process started. Fannie is about $20,000 on their loans. And that money is essentially spent on third parties and attorney fees. And so once that money goes in, you're not getting it back. I mean, you might get back $2,000 to $3,000 if they don't spend it. But the big thing that was hurting people was the deals were requiring earnest money that was non-refundable. And that was the bigger. So here in Dallas, it was like 1, 2, maybe 3% of the purchase price was needed hard money day one.
Yeah.
Whereas now that has been scaled back to almost no hard money, financing contingencies. So people weren't really concerned about losing the loan application fee. On these $15, $20 million deals. You lose 15, 20,000. Nobody was really concerned about.
Yeah,
they were worried about. They were hard 500,000.
Exactly.
That's where they were worried.
Of course.
So now there's financing contingency. There's limited hard money, and if the seller really wants to sell right now, then they are going to accept maybe a higher price and then more flexible terms. Right? They're going to say, "All right, we'll let you close this thing in 90 days. You can have a financing contingency. Like, we're not doing anything else. No other buyers are coming to the table. So we'll let you mess with this." Whereas before, there was 5 guys chomping at the bit trying to buy a deal for $15 million, and somebody was 500 hard day one.
Yes, I saw. I heard a lot about that, and
Yeah.
those are kind of the games that I didn't want to play. And I'm like, I might as well not even compete with some of these deals because I don't want to do that. I don't want to put money hard from day one. But I see that people that are doing it and they're getting deals. But in this market, that kind of
gone away now.
Yeah,
it's gone away now.
It's gone away. All right, so great information, James. Now, I think we have a great understanding of the Fannie Mae, the Freddie programs. Can you talk a little bit about some of the CARE Act that was just passed? Just lightly, I know this is completely changing on a day-by-day basis.
Yeah, I mean, I don't know if you guys read Pensford. Pensford has a great article out there about how this cycle is different than the 2008 crisis. So in 2008, the issue was securitizations went bad. And when the securitizations went bad, the banks went bad. And eventually that caused a downturn in the economy and affected your tenants. This crisis is almost the exact opposite. This crisis, the economy is halting. The tenants are not paying their rent. And then essentially they're not paying the mortgages on these properties. And that's going to impact your securitization. So it's like completely flipped. And so the government has essentially come out and said, look, we're going to, at the beginning of that cycle where the tenants are not paying their rent, we're just going to send them money, right? So individuals are getting $1,200. Married couples are getting $2,400. Kids are getting an additional $500. That's on the individual side. They're increasing the unemployment. So all that stuff is great for making sure that people have money in their hands. The question is whether or not it comes to us as rents, as multifamily owners. The other piece of that is instead of people filing for unemployment, they had 2 programs. One is called PPP and another one is called EIDL. And the PPP program essentially is for small businesses, 500 employees or less. And it said, look, we're going to give you the money, but you have to make sure that you maintain your employment and pay these people for the next 2.5 months. And so that program just launched, I think, last Friday, April 3rd. And the line was out the door. So everybody was applying for that program. It was essentially 2.5 times your monthly payroll. And so my best example is, let's say you have an apartment, 200 units, $1,000 a door. So you have $200,000 in payroll per year. And then 2.5 months, that's $30,000. So you can apply for PPP, $30,000. And then if the government gives it to you, then that will be forgiven. So that's pretty good. I mean, we've seen management companies apply for this. So if you have a third-party property management company, then that is one way that you can apply for it, because that will give you, most of the time, management companies, if they're under 500, that'll give you a chance to get that money. It is a little bit harder if they are not employees of you. So if you own the LLC and they are not your employees, it's a little bit harder to get that PPP program. The other one is called EIDL. That's an emergency disaster loan, essentially. And that one, it's up to $2 million, but it is recourse, and they require collateral typically on that one. And so that one's going to be more difficult for people who already have existing loans to get, because I think that's going to, most people aren't going to want to sign it. And then it might impact your Fannie Mae loans that you currently have on your property. So I would lean towards the PPP, just because that one there's no recourse, no collateral required. And if you can get it, or your property management company can get it, I think that one's the better fit.
Got it. Sounds like a lot of alphabet soup.
Well, I mean, the funny thing is, I think the SBA did, like, let's say 20 billion or 30 billion last year, the entire year in 2019, right? And then this program, the PPP, is 350 billion. And so they're trying to get this started in like 1 week and get the money out in 2 months. So 10 times the amount of money in, like, a quarter of the time. So we'll see if they can do it.
I talked to a few bankers already, and they said that they're just talking like they can't breathe. Like, they're returning emails like, it's so busy right now, I can't even respond. It's like, I could feel their pain with what they're dealing with. And I know why, because business owners need help right now. I mean, restaurants, people aren't going there. A lot of businesses, but it surprises me, and this is probably a conversation for another day, but it's just, how do you not have 30 days of reserves in your business? I just don't understand that. as a business owner. I know you maybe longer than that, maybe, but 30 days, 90 days, I think that's probably a good rule of thumb. But
yeah, I mean, that's what's tough. I mean, a lot of these businesses have been shut down by the government, not to any fault of themselves. And I mean, everybody in apartments, they're still using our asset, right? They're still in our business, and so I still think it's a fair ask of these people. I mean, I just got off a call this morning with about 10 property managers and asked them about April collections, and they're seeing anywhere from about 60 all the way up to about 90% in collections after 5 days in April. So I think people are being responsible because in the CARES Act, they're essentially saying, hey, your landlord can't evict you for the next 120 days. But people understand that, hey, they're using your apartment, you're using your assets. So they definitely are, they do not want to, be on bad terms with the person who's providing their home, especially during this shelter in place standpoint. So they don't want to be thrown out on the street, even though they can't officially be kicked out.
Mm-hmm. Yeah, and I would agree with those managers. That's what I'm experiencing. I just got an email from our manager, which we have a third party person, and we've collected 95% of rents.
How many units is that one?
76. It's over 3 different properties that we have them.
Good.
And the property manager stated there's a couple of people that paid partial, and then a couple of people that haven't been able to pay. And of course, we're going to work with everyone, but just like you said, they need to have a substantiated reason why they can't pay. It can't just be because, the government's saying we can't evict people, which I think some people are trying to take advantage of. I think very few to point it out, but I think it's still something that people say, hey, do I really have to pay my rent if I can't be evicted? But great information. So, James, could we transition a little bit? And you've given us some great information on lending. It sounds like you have some great amount of experience from the financial side as a broker, but also as a limited partner. Can you share some of your experience on some of your deals as a limited partner, maybe why you participated, and then some of the a good and maybe a bad situation from that?
Yeah, I mean, so back in 2015, I was looking at if I'm not going to invest in the stock market, if I'm not going to put money in a 401k, Roth IRA, then I needed to start saving up capital to invest in limited partners. And I started with sort of $50,000, $75,000, $100,000 chunks. And the way I started is I found general partners that were smarter than me. So I found guys who had been doing it for 5-10 years of multifamily experience. They had a track record. I could go out, see their properties. So they were here in Dallas-Fort Worth. I could call them at any time, email them at any time, answer any questions, really get me comfortable with the process. And I typically did one with a general partner, saw how that one went, saw how the communication, monthly communication was, saw how they performed on that property. Then I would add to it. So I would typically start with one property in 2015, one property in 2016. Even though they would have multiple offerings, I probably just did, every other one or something like that. And then most of my properties, when I started, my goal was to really replace my income with cash flow. So most of those deals were just sort of stabilized properties that qualified Fannie, Freddie, and they threw off at the beginning. It was probably 7, 8, 9% cash on cash. Towards 18, 19, 20, those were down probably 5, 6, 7% cash on cash. And so most of the properties that I did were stabilized, light value add, probably $3,000 to $5,000 a door, and then with general partners that I knew well and that I could call at any time. And most of those properties were they started sort of the B and C class, and then transitioned to more A- and B+ for the last 2 or 3 years. And yes, I mean, I never knew when the downturn was going to hit. So I tried to do like 1 a quarter in terms of my passive investing. And because when I started in 2015, everyone said that was the top. So I could have sat there for 5 years and not invested in anything. So, but majority of the deals in 15 and 16 now have been sold in the last year and a half. And all those probably returned probably about 1.5 to 2x. And then the ones that are remaining were really bought in 17, 18, 19. And those are throwing off anywhere from 5 to 7% cash on cash right now.
Perfect. Now, and you mentioned 1.5 to 2 times. You're talking about equity multiples
Equity
there.
multiple, sure. Yeah.
What about on the IRR side? What were the IRR returns for some of those deals as a limited
Yeah, I mean,
partner?
it probably ranged from about 15 to 30%,
Okay.
just depending on how some deals we were able to turn pretty quickly and had a good basis in, and then we were able to find, a good buyer very, very quickly. Whereas some deals took, 4.5 years. Some deals I invested in 2015, we just sold like in the last 6 months. Some deals I invested in 17, they sold in 19. So some of those were sort of quick turns. But overall, I mean, most of the deals were right in that 1.5 to 2x equity multiple. And, going forward, I think most people are probably, people were probably down in that like 10 to 15% IRR sort of pre-crash. But now with this COVID-19, people are probably going to want to be 15 to 20 IRR on any deals going forward. Similar for me, I'll probably, start back investing when it's probably 8-9% cash on cash.
Got it. Okay, great information. Now, what would you recommend? You mentioned you looked up some sponsors, some general partners is what you said the word. They call them sponsors, same thing. It's a person that's operating the LLC. They're finding the deal. They're putting the investors together. How did you find some of these people? Was it through your network because you're a broker, or did you do anything different?
One of the general partners I worked with, he was actually at GE. He left GE in 2010. So he had been doing it 5 years while I was out. While I was still at GE underwriting deals, and so he had a track record. So that was the first one. Second one was sort of my network of people. As I was a broker, I saw a lot of different general partners, and he had already had a track record for 2 or 3 years. Other general partners I work with personally, and so I work with them on almost every deal. And so that obviously gives me a lot of comfort as they're using me for the debt typically. Then I see everything that they go through, and so that's a little bit of an inside advantage. But I would say I think if anyone's out there, you sort of leverage your network to find them. And then also I always talk with other limited partners and ask them to give me sort of their top 3 or 4 general partners and interview them and sort of get to know them. And then I usually ask those general partners to send me like maybe the last couple of deals that they've done that are already closed, and potentially as deals come up, just add me to their list, and then I start reviewing deals from that perspective. But I've done deals. Let's see, I've done deals in DFW, Austin, San Antonio. I mean, I have lived in all those markets and worked in all those markets a lot. So there's a little bit, I mean, people would send me deals in Florida and Arizona and different places in Atlanta. But I just don't know those markets. And so, I mean, I think number one, you have to be comfortable as a limited partner. And number two, the general partner needs to know more than I need than I know. And so if they meet that criteria, then I'm usually okay investing with them.
Okay. Fair enough. So a couple of things to rehash. You mentioned relationships. That's how you really are finding a lot of these people. You're looking at track records of people that have done this before. You mentioned 3, 5, 7 years of that they've been doing it. And then something else you mentioned was you would try people out, which you wouldn't invest in all their deals. We kind of dip your feet in the pool a little bit. If it works out well, then you kind of continue on the next deal. Is that about right?
Yeah. And I mean, like in one deal, I'll put let's say I put 50,000 in 2015. And then let's say they communicate quarterly and there's no distributions, and I can't call them on the phone. They don't return my call. They don't return emails. Then in 2016, I'm probably not reinvesting with that person.
Exactly.
Right? So I mean, if I was a first time syndicator, what I would do is that first group of, let's say 20 people who are in your deal, treat them as gold, because they're going to give you referrals. You can, ask people, new investors to be able to talk to them. I would have visits at your property. I mean, most people who are limited partners eventually want to become general partners to some extent. And so the more that you can help them and teach them about the business, the better. And the more part of it that they will feel. Because one thing we haven't talked about is, look, if collections in April come in fine, that's great. But what about May and June and July? If those are down significantly, then you might have to call these 20 people and say, hey guys, we need another, 10,000 from each person to make it through this in terms of a capital call. And, the better they know you as a general partner, the better they know that you've tried everything. You've applied for these programs, you've applied for forbearance, you've applied for all these different things out there and this is the only way to avoid foreclosure. Then I think you're more likely to receive money than if, you haven't said anything for 3 or 4 months and then all of a sudden you pop up in July and say, hey guys, we need 100,000 from each person. It's going to be a very tough 20 calls for you.
Yeah, no, I'm with you. I'm actually a limited partner in a deal. And then that's one of the challenges I've had more with the sponsor of that deal is the lack of communication.
Right.
That's really one of the biggest challenges. And I think if you communicate, even if things are bad, but we're aware that things are bad, you have such a better relationship. You have such a better a feedback, a response, like you said, if the situation comes. Now, can you briefly go over just some of those options that sponsors have in this time? You mentioned forbearance. Right now we went out and we said, we're keeping our investors informed. We sent them an email what we're doing. We're not collecting late fees. We're not doing rent increases. We're slowing our capital improvements. What I'm planning on doing myself is we have some reserves, thank goodness. But if not, I'm planning on doing a loan to the company, to kind of hold it up throughout that. But what are some other things that sponsors can do if, other than capital calls, which you've talked about?
First of all, let's look at collections take it from a P&L standpoint. Let's start with the collections and then look at your expenses, whether it's a, 30 to 40% drop in collections and then maybe a 10% drop in expenses, figure out how long you can survive, right? And so if you have, like I ran it on like a 200 unit property here in Dallas, the mortgage payment was like $70,000 a month. If you have, 150,000 in the bank, that's only 2 months, right? So if your income drops 50% or 30% and you can barely cover your expenses, you only got 2 months to survive. The first thing I would do is figure out how much runway you have and what your capital currently in the bank is. And then at what point do you break? If you see you're going to break next month, you better call your lender and ask for forbearance, because I don't think it's going to get any better. But if you can reach out and do a loan or capital call to see it through, I would just make sure that you see the light at the end of the tunnel to some extent. Forbearance. So Fannie Mae and Freddie Mac have come out with basically a 3-month forbearance. So that's 90 days. You can't evict, similar to the CARES Act already. The big thing I would say is Fannie Mae has what's in place is the cash flow sweep. So any excess income, so all your revenue comes in, you pay all your property expenses, any excess income is going to go to them. So that is new. So there's a cash flow sweep during forbearance. And then also you have only 12 months to pay it back. So this is a very short-term, pause in your payments. It is not where you can, I'll throw down the end of the mortgage, when I refi or pay it back. You have to pay it back within 12 months. Got it. So forbearance is a very short term. If you either have the money as a sponsor in terms of a loan for the property, or you can raise the money from a few limited partners, I think that is a better option than forbearance. You will have, and then, as a general partner, you just don't want anything negative on your record. Most people, they won't be trying to buy a new deal right now, but let's say you're in forbearance and then, 6-12 months from now, you go back to Fannie and Freddie and you want the best pricing, the best leverage, the best interest only. You're probably not going to get it because they're going to say, hey, like 6 months ago, you were in forbearance. Like you couldn't even cover that deal. And now you're trying to buy a deal that's, twice the size. Like that's not going to work. So I think if people can avoid it, avoid the forbearance, but obviously do not, you still want to avoid foreclosure. So it's one step above foreclosure. So.
Okay. So good advice. You mentioned some great points for limited partners. If people aren't returning your calls, and I would say if you invested, probably that's too late, but if they're not doing it from the beginning, and people kind of hide themselves at the beginning. So be careful.
Right.
But vet people, get referrals. That's how you're going to meet people to work with. If you're either looking to just be a limited partner for that's your goal, or even if you want to become a general partner one day and learn from some. Now, you mentioned some of those same advice kind of applies to sponsors. Communicate with people. That's how you're going to attract capital to your deals. Any other recommendations you have for sponsors so they can build their capital base and their limited partner base?
I mean, right now, I would definitely. One thing that would help, I think, is I like when actually general partners do a couple of LP deals first. And instead of saying, all right, I took, a 2-day boot camp over the weekend and now I'm a general partner. I'd rather that person actually get some education, but then I'll actually invest in a couple deals as a limited partner, and then potentially partner with that person who has a longer track record, because it will actually help their ability to get loans in the future. So let's say you partner with someone let's say you invest with someone who's a limited partner this year, or you're the limited partner in their deal, and you put $50,000, $75,000, whatever it is. You see how that person operates for 6 to 12 months. And then in 2021, you actually partner with that person. That person already has multifamily experience. You can go out and actually get a better Fannie Mae loan, Freddie Mac loan, and actually probably win a deal. It is actually very hard to be a general partner straight out of the gate, either to win a deal. But if you have that other person, you can lean on that person's track record and say, hey, look, we've bought 10 deals in this market. Let's partner on this deal. Maybe split the general partner compensation. And then after you've done one deal with that person, you've leveraged their track record, you leverage for the deal, but then also leverage that person's track record to do the equity raise. And then going forward, you could potentially do a deal on your own or stay with that person. So I like that model a little bit better than trying to come out just cold out of the blocks, because you don't really have a track record, right?
Yep.
So almost every good general partner that I've seen on that second deal, they've partnered with someone who's more experienced. And then, look, if you end up being great partners and you want to do deals together for 10 years, great. But if you don't, then, each one of these is like an independent marriage to some extent, right? Like you have to figure out what everyone's roles and responsibilities are going to be. And some people are going to be like, look, I'm going to help you on this deal, but you're going to be the asset manager. You're going to do the day-to-day stuff. So you have to be able to sort of raise your hand and say what you're going to do and what value you're going to bring to the table. And one of those things is, these general partners have a lot of people knocking on their door saying, hey, can you work with me on this transaction or this transaction? But very few of their limited partners, I would say, who have actually put money with them, actually raise their hand. So I think that's one way to stand out and help in terms of a track record. In terms of other things to do as a general partner right now, I mean, right now if you don't have any sort of education out there, like anytime I introduce a general partner to a limited partner, I usually just like send them a link to their website. And if you don't have any sort of education out there about how people can get educated about multifamily, I think that is one thing that you should be doing.
Okay. Great advice, James. Thank you for that. Very useful. All right. Now, I think we're getting ready to close this up. And you've been a lot of nuggets here. I always say, if you can just get one nugget from either one conversation or one interview, you can use it to make $10,000, $20,000. I like the one that you just mentioned. Don't just go from the boot camp right into owning a deal. Yeah. Be a limited partner. Can you share any kind of book, business book recommendations, or even real estate investment book recommendations? A couple of things that you keep close to you in your library.
Yeah, I mean, so if you want to, so another guy that I read a lot is Howard Marks. So Howard Marks runs it's more like a debt fund called Oak Tree Capital, and he puts out a memo probably once a quarter. And he wrote a book called The Most Important Thing. And it's 21 of the most important things that he thinks every investor should know. Warren Buffett actually quoted his book and said that when his memos come out, it is the first thing he reads. So I've been following him for the last 6 months or so. He was interviewed on Tim Ferriss's podcast a while back as well. So I think you can either buy that book or even download it online. So most important thing, Howard Marks, that actually gives you a very good idea of cycles. He talks about, of the 21 things, one of the things is risk. Another one is cycles. And then he also talks about defensive investing. And so I think it's a very good book to be reading right now in terms of understanding where we are in the cycle. The standard books, I mean, if I sort of look at it as, if you haven't read sort of your basic finance books, I mean, I always recommend people to start sort of even with the basic, like Dave Ramsey book. You've got to get out of debt, start there. But then if you want to move up to sort of Robert Kiyosaki, Rich Dad Poor Dad, Cash Flow Quadrant, start there. And then as you grow and sort of move up to maybe your business books, you could go with like E-Myth, like Gerber has a great book on that. So, I mean, I think as you sort of stair step up these things, those are the books. Those are my favorite books. Those are the books that I recommend to people who are just getting started. I haven't really seen just a pure real estate book because I think the information's moving so fast right now that by the time someone puts out a book, it almost becomes it's more principles. I'd rather read some of these books that have more standard principles in them that apply throughout cycles.
Yeah, because principles are applicable all the time, right? Yep. So great. Those are very good books. I even though I haven't read Dave Ramsey's books, I have studied what he recommends, and I'm a big believer in getting out of debt and getting good debt, and then Kiyosaki and E-Myth, and I have not read the Howard Marks, which after hearing you on the other webinar, I actually added it to my list. So that's definitely something I want to check out. Now, the last question I have for you, James, what do you think is it? I'm a big reader, follow a lot of success, a lot of people that make things happen. What do you think is it that separates the people that are successful, whether it be in business, it could be in syndicators, from the ones that, they go up to you, they say, I want to buy a property, and then they actually go through and they get a loan done, they find it, they close it, compared to the ones that actually they call you and it sounds good that they're interested, but they never get the loan done, they never follow through. What's going on there?
So I would say there's two gaps, okay? The first gap is from 0 to 1, right? So at all these boot camps, let's say I meet 100 people, there's only probably 10 to 15 who actually do one deal, okay? Mm-hmm. And those people typically push through. That is more of a determination game. They go to all the networking events, they meet all the brokers, they put in offers. I mean, a lot of people who are stuck on 0, when I meet them, I say, how many offers have you made? 0. How many tours have you done? 0. They have not put in the effort to really push through that. And so once you get that first deal done, it's almost like a snowball, and you can do more and more. And I've seen people who have essentially bought one deal and they've bought a deal a quarter for the next 4 years or 5 years. And They actually make this a business. Whereas other people, they buy one deal and I never see them again. And I think the difference between those two is some people, they're a syndicator and they have a full-time job, whether it's in IT or engineering or whatever. And it's like they're trying to, the analogy is like you're standing on the dock with one foot and the other foot is drifting, the boat's drifting away. Like at some point you have to make the jump to say, I'm going to be a full-time syndicator. I'm going to be a full-time general partner. And this is what I do. And there's no backstop. Then that's where I've seen people sort of really accelerate and start doing, 1, 2, 3 deals a year as this is their business. And so I think a lot of times that is the difference from going 0 to 1, but then also 1 to 10. Right. So the people, I think to really scale the business, to really make money in this business, I think you really need at least 5 to 10 properties of size. And, that's going to take a lot of different team members. It's going to take a lot of different key principles. It's going to take good, listing brokers, loan brokers, asset management, property management, all those things that all the gurus talk about. You need all those things to really scale it up to a 10, 20 property portfolio.
Awesome. All right. Well, James, again, thank you so much for being with us today on the Everything About Wealth podcast. It's just been a lot of information. We're going to put out a lot of the points that you recommended from the books the books that you mentioned, a lot of the other points on our website. So we'll send you the link for that information. For everyone else, thanks for tuning in. Hope you are able to take advantage of all the great tips that James shared. You can reach James at 214-300-5035 or via email at jeng@oldcapitallending.com. We'll also put links to his website and LinkedIn on our website. Now, I hope you enjoyed the call and that you learned some valuable nuggets about Fannie, Freddie, and working with private investors. If you found it valuable, please leave us a review wherever you're listening. Now, to learn more about real estate investing or how to be a capital partner, visit our website at www.everythingaboutwealth.com. And with that, we'll see you on the next show. Take care. Bye-bye.